You are listening to the Exitology, Unlock Your Profits, Unlock Your Potential show on the #1 global talk and news network on the internet, IBGR, International Business Growth Radio, the world of business at your fingertips. I am Jason Wally Waldron, the secret weapon behind owners, founders, and CEOs of blue-collar and industrial companies who apply Exitology to grow faster and maximize the value of their business. When these owners feel trapped in their businesses, we apply Exitology so you can buy back your time and freedom. I am your host for today's show. This season, and the last few seasons, frankly, we've been talking about creating lasting value, even in a challenging economy. And today I have a very special guest. His name is Kyle J. Christensen. And Kyle is the author of the book, Principles-Based Planning, A Better Approach to Financial Planning. He is the founder of Unique Advantage, which is the original principles-based financial planning firm. And the objective of his company is to teach clients principles that predictably lead to becoming and remaining financially free. He's also the founder of 5th, which is an organization that trains people on how to become a principles-based financial planner. And he has a whole lot of other things going on, which you could certainly read in the show notes. And one of the great things about Kyle, too, is just on a personal level, he has been married to the love of his life for 25 years this year. So congratulations, Kyle. And with that, welcome to the show.
Thank you so much. I'm happy to be here. It's an honor.
It's an honor to have you too, and I'm really looking forward to our discussion here today because, you know, as we're talking about the concept of the business side of things in Exitology and helping people buy back their time and freedom, it's super and completely aligned with what you're doing on the personal financial side of things. And so I'd like to just give you the floor for a couple minutes, Kyle, and maybe just walk us through, you know, what is this concept of principles-based planning? How is it different from what people might hear about, you know, the more common styles of planning that are out there? And honestly, why did you feel the need to create a different approach?
So just a little bit of background, I think, would be helpful. So I became a certified financial planner early in my career, and I've been doing financial planning for about 25 years this year, 24 and change. And I just noticed early on that what traditional planning teaches, what traditional planning promotes, which is very commonly accepted and across the industry, has just really not created financial freedom for people. What it's led to is financial dependence. And so,
interesting,
you know, just being able to recognize that, I'm blessed to be able to recognize inequity or something like that, you know.
Sure.
And I just see where, and I think most people feel this, they feel that the financial planning industry has won, right? But the average Joe has not. And so I think that's kind of the genesis of why I decided to, you know, try to figure out what's a better approach, what's a different approach that people can take that actually works to help them become financially free.
So yeah, so I mean, you know, first of all, congratulations, a quarter century hanging out in the financial planning business. You know, that makes you, shall we say, an old man in that industry, and or a veteran is probably a much more appropriate word. But early on, you noticed a fundamental flaw in the approach, right? Which, and you tell me what I'm missing here, but the approach that I hear all day long goes something like this. It says, hey, what's your number, right? And there's a financial freedom number, and it might be, say, $10 million because 4% of 10 million on the safe withdrawal rate is da-da-da-da-da-da-da-da. And they kind of walk you through this thing that happens really, really fast. And yet you're saying that that common approach that you hear all day long is actually flawed. Tell us what you discovered and how you went through that discovery.
Well, a really good mentor that I had early on in my career, his name is Bob Castellone. He's an economist by profession, but he would say that math isn't money and money isn't math. He said that money is more like oranges. And you'd say, what? What do you mean by that? He'd say, well, if you put 2 oranges on the table here and you came back 25 years from now, what would be on the table? And you know, they would have eroded. They may have turned into kind of a dust, or there might be a stain or something. And that's really how money works, a lot more like oranges than it does math. So that's the problem, right? Is that, just like you said, the approach that most people hear or see or they've been taught is, take your money that you want to save every month and compound it at a certain amount of interest. And then you're going to grow this nest egg, right? Which is whatever amount of money you supposedly need in the future. And then you're, like you said, take the save withdrawal rate and figure out what kind of income you can get from that. And, just from the very foundation of all of that, it's flawed, right? Because money doesn't, it doesn't really, like, for example, the stock market doesn't really compound interest as a fundamental aspect of that, right? So if we're trying to predict what Wally Waldron's going to have in the future and we use a compound interest calculator, we're already starting wrong, because that's not how that works.
That's a really interesting comment that you make there, because, the typical approach that we hear a lot out there in the marketplace is, max out all of your tax advantaged, your 401ks and the like, and essentially dollar cost average into, different types of investments, rebalance portfolio every so often, and all of these other things. And yet you're saying that the math part of that is actually not correct. And I'm hoping for the listeners, we can maybe demonstrate a little bit of that. I know that I went to one of your training sessions early this year, and it was really interesting because you actually shared how I could basically demonstrate that you had a positive return, and here's how you also lost money. So what is that all about? Can you maybe walk people through that strange? What is that, Kyle?
Yeah. Well, ultimately, it's marketing, right? And the problem with, and this kind of goes back to why principles, if we don't have principles as the foundation for our decisions that we make, no matter where it's at in our life, then we're more subject to marketing, and we're more subject to hype, and we're more subject to following the herd and what's popular. And so, when we look at, things like average rates of return, which is what you just brought up, how do mutual funds market their wares, basically, right? How do they convince people to put money into them? Well, they say, well, here's our last 5 years average rate of return. Here's our last 3 years average rate of return. In 24 years, this is interesting side note, I've never met a single person who could tell me the name of any fund manager where they had money invested. They just couldn't even tell me one person. But what they do know, how do they make a decision? They look at past fund performance, right? In the marketing material, which is what it is, the marketing material that the fund family gives the employees, right? Right. So that they can choose where they're going to put their money. Well, how do people choose? They look at which one did the best, right? Which one had the highest average return over the last 5 years or 3 years or whatever. Yep. And if you've taken statistics in college, then you know that average is really actually a pretty terrible indicator to use for anything. Right. Mean is a much better, or a median is a much better indicator. And if you do use average, then you also need to know the range, like how high and how low. You need to know more information because averages can be super misleading. And so the example that I used in that presentation is, I said, let's say you had $100,000 and you make 100% rate of return in the first year. Okay. What's your ending balance? It's 200,000. Right. And what happens if you lose 60% the next year? So you gained 100% the first year, you lost 60% the next year. Well, now you're down to $80,000. And hopefully your listeners will do the math, right? Yeah. But 60% of $200,000 is $80,000. Right. Well, you lost money in your account in this example. You started with 100, now you're down to 80. You lost money, but what's the average rate of return? Well, to get average, again, math isn't money and money isn't math, but you take the 2 years returns and you divide it by 2, the number of years, right? So 100% and plus the minus 60 divided by 2, and you get a 20% positive rate of return is what you got. So a mutual fund that lost your money could actually honestly, on a sheet of paper, say we averaged 20% rate of return over the last 2 years. They know, however, that they lost money,
Oh
right?
my gosh.
But
So I want to point out for a second here because a lot of our listeners are very engineering minded, very left brain, so if you didn't follow, like scrub backwards and go through the math if you didn't follow that, I'm sure you all did. But that's an amazing demonstration of the difference between marketing and reality.
yeah, yeah. I mean, what matters to people? What matters isn't average rate of return. What matters is that I made money or I lost money. It really
Right.
kind of comes down to that. And, Wall Street knows that people are doing this blindly. They promote it, right? They promote laziness. They promote, that's what you brought up, dollar cost averaging. Well, what
Yes.
is dollar cost averaging? Dollar cost averaging is putting money into investments every time you get paid, right?
Right.
And how much evaluation is happening when you do that?
Right. Nothing, right? It's
Zero.
yeah. Oh, well, yeah, I think the word that came to mind, and you did not say this word, this is my word, but was abdication. I,
Yeah.
right?
Abdicating responsibility, right?
Yep. Yeah, exactly. I feel that there's a lot of incentives, and I know we're going to get into this here in a few minutes. There's a lot of incentives and education, frankly, out there that invites the end user, the consumer, whatever you want to call that, to abdicate their own thinking and abdicate their own responsibility, so that hopefully later on you have that number. Um, yeah, Kyle, we're going to take a short break here for about 2 minutes. Before we do that, can you tell people a little bit about where they can find more about you and your firm?
Yes. Please go to our website, uniqueadvantage.biz. The last 3 letters are B as in boy, I as in island, Z as in zoo. So uniqueadvantage.biz.
And friends, I'd like to also point out that Kyle has a really, really interesting book called Principles-Based Planning, A Better Approach to Financial Planning. I read it. I actually have my hand on it right now. And there are probably about 30 pages that are either folded over or have little sticky notes sticking out of them. So it's a very interesting read. You are listening to Exotology, Unlock Your Profits, Unlock Your Potential show, and we will be back in 2 minutes after this short break.